Hello and welcome to the next of our lecture recaps. Remember, you can download all of the mind maps you see here for free as a PDF from the website shown, or indeed you can purchase the full course on which this recap is based should you wish to do so. So IFRS 8, first of all, remember this was looking at segmental reporting. So that's a section in our financial statements, a note to the accounts that breaks down the information by certain segments. So this is operating segments. We need to decide what segments we put into this report. So the first question is it an operating segment? Well, it is if it undertakes business activities that earn revenues and incur expenses. Also, they need to have operating results that are reviewed regularly by the chief decision maker, usually the CEO of the entity. So they'll look at those to make decisions. Also, there needs to be discrete financial information available. So if it meets those criteria, well then yes, it's an operating segment. The next question is, how do we actually report it? Well, it's reportable if it makes up 10% plus of total revenue, 10% plus of total profit, and 10% plus of the total assets of the entity. So if it meets any of those criteria, well then yes, it goes into our segmental report. Remember that 75% of the entity's revenue must be in the reportable segments. If we haven't, i.e. we have an other segment that's made up of lots of little bits, that's more than 25% of the total entity revenue, well then we need to break that down into reportable segments. So until we have 75% of total entity revenue in those reportable segments. We can also aggregate 2 or more segments if they have all the same product, all the same type of customer, or all the same distribution method. Also, if they're in the same regulatory environment, again, we could bring those together and aggregate those 2 segments. When it comes to disclosures, well, things we need to disclose in our segmental report will be number 1, internal and external revenue from the segment, the profit and loss from the segment, the total assets and liabilities of the segment, the interest income and expense of the segment, and the tax and depreciation of that segment. We then moved on to substance over form. Remember, substance over form is where we should show in our financial statements the economic substance, not merely the legal form of a transaction, i.e. we need to show what's really happening, regardless of what it says on a contract, for example. Why do we need to do that? Well, we need to avoid manipulation of the accounts by clever accountants. So they might just reflect the legal form rather than showing what's really happening. So for example, they may not capitalise a lease. They may have a document that says that a lease is an operating lease, when in actual fact, the legal ownership of the asset transfers at the end of the lease, making it actually a finance lease that should be capitalised. Well, regardless of what the legal document says, it needs to be treated as a finance lease, i.e. the substance over the form of the transaction. So the substance, remember, is who gets the benefit of an asset, back to the framework, the benefit of the assets, back to the conceptual framework definition of an asset, and who is taking the risk and rewards, again back to the framework. We also looked in particular at consignment inventory. Remember, this is inventory that's owned by one party and held by another. For example, a car dealer. And we're asking here, who should have that inventory on their financial statements? Is it the manufacturer who gives the cars to the dealer? Or is it the dealer who holds the cars on their premises? Well, what we need to do is ask ourselves several questions. Number 1, who bears the risk of ownership? For example, if the price falls, who bears that risk? If the asset is damaged, who bears that risk? And who gets the benefit, i.e. the profits? If it goes up in price or up in value, who gets that benefit? And also then we can decide, based on those, who owns the inventory, who should show them on their financial statements. And we did an example of that in illustration 2. We also then looked at sale and leaseback transactions. So this is where a business sells an asset and then leases it back. Particularly on a finance lease, first of all, the excess of the proceeds over the carrying amount, i.e. the amount you sold it for over the carrying amount, the profit. What do we need to do with that? Well, we defer it and amortise it over the term. So we put it in as deferred income and we release it over the term of the lease. So we debit cash, credit the asset and credit deferred income with the difference between the proceeds and the carrying value. We then create a finance lease based on the new fair value, debiting the asset and crediting a finance lease. And we treat that the same as any other finance lease then. So we looked at that in illustration 3. If it's an operating lease, we de-recognise the asset and the sale is recorded. The lease rentals then go to the income statement like any other operating lease. Lastly, we talked about sale and repurchase agreements. Often what we'll find is that in these, an asset will be sold and then there'll be an agreement to buy it back at a later date. So what we need to see here is, using substance over form, is this a sale of the asset or merely a loan? Should we actually de-recognise the asset and show it as a sale? Or is it just a loan where they've got the money up front, they're going to pay it back later on, and there's an interest charge involved? If it is that, well then we need to treat it as that in substance over form. So again, we looked at illustration 4 to show how to do that. So that was a recap of our lecture on IFRS 8 and substance over form.